All right. Today is Sunday, the 3rd of December. This is a recap for the stock market activities last week and an outlook for the week to come. Now, folks, I got a good one for you tonight. We finally have the results from the month of November, and it was one of the best Novembers in stock market history. We are partying like we did back before the Great Depression. Whoops. And for a lot of you who don't follow the stock market, you just watch the channel for the macro commentary. When you hear the news and you hear everybody on Twitter talking about, oh my God, bull market, we're rallying to the moon, understand that all we did in November is just go back to the highs from July. That's all there is. Net, nothing happened. And net, if you go back 2 years ago, if you bought the stock market almost 2 years ago, you're now back to even. Congratulations. That's the bull market that everybody's jerking off to. But of course, we have a lot of winners. Maybe the stock market been flat for 2 years, but your money manager is rolling in cash. Bonuses, commissions, stay in the market, time in the market better than timing the market. Just stay in there, so we can cash in more commissions and more bonuses out of your account. And you might look at this and say, but wait a minute here. What if the stock market stays flat for the next year or 2 years or so, maybe go down? Wouldn't it be better just to lock in some of these high rates before they go down? Maybe I'm better off sticking my money in a CD or in a T-bill, a muni, something. Lock in some of these high rates before they go down. Oh, you're not going to win. Your money manager would say, no. Why would you do that? Just keep your money. Again, timing the market is better than timing the market, baby. Stay. But speaking of money managers, this week we lost a legend, Charlie Munger, rest in peace. The man passed at the age of 99, just a few weeks short of his 100th birthday. The big guy upstairs has a dark sense of humor. He pulled the plug just a few weeks before the man's 100th birthday. But a lot of folks talk about Warren Buffett being the greatest investor of all time and all of that, and at least here in this channel, we certainly love Buffett. But I think that Charlie Munger was the greatest investor of all time. You see, Buffett, his whole thing was to buy really wrecked companies, fixer-upper, fix them, make them whole again. That was his thing, deep value. Then came Charlie Munger to Berkshire Hathaway, and he said, no, you don't have to do that all the time. All what you got to do is just look at companies, reliable companies, solid growth with good valuations. It's never going to fail you. You do the fundamental analysis, you look at companies with solid, reliable, sustainable growth. If they're trading at good valuations, you're in. And this strategy never failed. Berkshire Hathaway outperformed the stock market by a mile. And of course, most of us investors and traders, we have our own stories and our favorite pieces of Charlie Munger's wit and wisdom. So rest in peace, Charlie Munger, one of the greats gone, but we're always gonna remember here. It was also an eventful week, not just Charlie Munger dying, but we also got the release of the Cybertrash by Tesla. And I know a lot of you want to buy it and you put in the order, you thought you're going to pay 70 grand and now you got to pay 100 grand. So I don't know if you're going to cancel or not, let us know in the comments. But don't park this thing in my block, because when I take the trash out, I might confuse your car for the trash bin. I mean, your trunk space is pretty good for a few bags of trash, not so much for hauling a bike. So enjoy. But folks, we also keep getting the fantasy of the light at the end of the tunnel. When the Federal Reserve raises rates to combat inflation, and then we see inflation responding, and everybody says, okay, mission accomplished, soft landing, Goldilocks, everything's fine. And then it always ends up in a disaster. But there are stages of denial here, because when we talk about inflation, when you get the data saying cooling inflation is going down. What is inflation? Inflation is the rate of increase in prices. So when they say inflation is going down or cooling down, what they mean is the rate of increase in pricing is slowing down. That's all there is. It doesn't mean the prices are going down. You and me, when we go out and shop in the economy, certainly at the grocery store, we don't see prices going down. We're choked over here. But of course, the stages of denial here. Stage number 1, gaslight them. Tell them that we're doing fine here. Look at this, inflation is going down. And Anybody feeling it? So you got President Joey B coming out. It was a tough week for Joey B. He got community noted not just once, but twice.
Come on, man.
He comes out and says inflation was 0% last month and our economy grew by more than 5% last quarter. Bidenomics, Jack. And of course, the problem with this is inflation is actually at over 3% year on year. So inflation is going higher, be it at a slower rate. So we're not seeing a reduction in prices here, which we need desperately. And oh, by the way, the GDP that he's talking about, 5%. We talked about that when it came out. The component that led GDP to go to 5% was government spending, not consumer spending. Consumer spending actually went down. So the heart and the core of the economy, consumer spending, is slowing down. But because of the insane, reckless spending policy by this administration, we see the GDP being manipulated higher. Of course, there is a price of this insane spending, which is higher yields in the bond market, which is going to wreck the economy because they have to keep issuing more and more bonds to finance the budget deficit and the spending. Otherwise, the other alternative would be raising taxes, just like the good old days, by 90%. Then they can pay for all of this spending. Anyways, this is stage number one. Did not work out for Joey B. He got community noted. People said, hey, you're lying. Inflation is going higher. The GDP is bullshit. So comes stage number two. Sure, yeah, inflation is not going down, but it's the corporations, the greedy corporations who are doing price gouging. Let me be clear to any corporations that hasn't brought their prices back down, even as inflation has come down. It's time to stop the price gouging. Give the American consumer a break, Jack. And he got community noted again. Most companies are having really bad margins, meaning they're not doing enough price gouging. Their costs are actually going higher, but they can't raise prices anymore because the consumer is getting hurt. The consumer can't afford to pay higher prices, so we see companies going bust. The margins are going negative. But when it all fails, the last stage of denial here, folks, it's your fault. Inflation is your fault. You're so mad about inflation, well, stop buying stuff. Stop eating. Stop drinking. Stop commuting. Put your mask on and shut up already, Jack. And I wonder what they're going to say when the economy slips into a recession, which could happen really, really soon. Not just a recession, but a major economic crisis. Something big blowing up. What are they going to say? Who are they going to blame? Is it going to be White House versus the Federal Reserve? Or is it going to be our fault again? Why did you stop spending in the economy? Recession is your fault. And I know what you're going to say, but Maverick, the stock market keeps going higher. Even though I just showed you it's flat, it keeps going higher. It means the economy is doing fine, right? It means that we're not going to have any crashes or anything here. All I got to say to you is those who don't understand history are doomed to repeat it. And if you look back at history, once again, the fantasy of the light at the end of the tunnel. So what do we see right now? We see an environment where everybody assumes that, okay, mission accomplished. The Fed raised rates. Inflation is going down in the right direction for now. Not all the way down to the Fed's target of 2%, but close enough. And if we look down the road, we see the Fed cutting rates, which means all of these assumptions of all higher rates will blow up the economy and will cause systemic risk and a recession and all of that is behind us right now. So we see behaviors such as short covering in bonds, buying bonds all of a sudden. Bonds, of course, been crashing as yields and rates been going higher. Now we have a rush to buy back these bonds, assuming that the episode is over, the worst is behind. Well, gee, when did we see that last? The answer is right before the crash in 2008. The same fallacy, the same mistake. We see them also rushing to buy junk bonds, HYG, corporate bonds, LQD, government bonds, TLT. Biggest rally since, once again, 2008 before the crash. Why do we see this though, Maverick? Why do we keep seeing this? Hold your horses here. I'm going to explain to you in details. But here's the most immediate problem, folks. The market keeps getting ahead of itself because we talked about this before. The market is in the drug addict mentality. Years and years of quantitative easing. All what the market cares about right now, what the Fed is going to do. If they cut rates, if they reduce the tightening in the policy, boom, we have to get ahead of it and go crazy and overreact. And they almost always proven wrong. So now we see within a few weeks, market expectations are now placing a lot of bets that we're going to see cuts, a lot of cuts in the year 2024. And matter of fact, as early as the month of March of 24, 60% odds that the Fed will cut rates by then. Well, the common thinking goes, what's been restricting the economy and holding the market from going higher is the Fed raising rates. So if the Fed cut rates, that would be good for the economy, good for the market. Here's the problem. Historically speaking, every time we've seen rate cuts showing up, they happened for the wrong reasons. And that was actually a really solid indicator that the economy is now slipping in a recession pretty much every single time. Every single time. The Fed cut rates, it was for the wrong reasons, and shortly thereafter, we got a recession or we got a crash of some sort. Well, what is the wrong reason that would permit the Fed to cut rates? The answer is economy slipping into a recession, be it by the unemployment rate rising higher or a systemic risk event that causes a lot of stress in the system and causes the Fed to react by cutting rates. And that is the risk of a recession. We also have the risk of reinflation again. Ladies and gentlemen, we now have the dual risk. See, in the beginning, if the Fed reacted as it was supposed to by raising rates aggressively to tackle the inflation problem early on, while the economy was intact with a lot of cushion, we only had one risk, and that is the risk of inflation. But now we have the dual risk. We have the risk that if you begin to loosen, inflation comes back. And if you tighten more at this stage, well, the economy is going to blow up. It's going to go into a recession, and the severity of the recession will be determined by how aggressive the rate policy is. In the meantime, there is this quiet period where we can say mission accomplished. Inflation went down, nothing blew up in the economy, unemployment is still low, and maybe if the Fed begin cutting rates, inflation will not come back, but growth will, and everybody's going to live happily ever after. And this fallacy causes overreactions in the market every single time. I'll show you in a minute, but when we talk about the dual risk, look at what happened to the financial conditions index. The moment the market went with the fallacy of, okay, the Fed is done, next thing you know, it's rate cuts, nothing is going to happen to the economy. We see financial conditions loosening by the most pretty much in history, at least recent history. This is exactly what the Fed doesn't want to see because the loosening of financial conditions will work against their mandate. The Fed right now is being really careful. The way they see it, we got to the restrictive rate. We're seeing the economy being restricted, be it credit lending conditions or consumer spending. So far, so good. We see inflation going down. So far, so good. But if the market goes crazy and they want to loosen financial conditions, assuming that we're going to cut and announce mission accomplished, then they will make our job harder. And that's the risk of reinflation. When we talk about the dual risk, this is the risk of reinflation. Here's the commentary about this chart from Jim Bianco. In November, bonds had their best month since May 1985. The S&P 500 was up nearly 9%. So it should not be surprising that financial conditions eased more in November than any month in the last 40 years. Last month, Powell said financial conditions were doing their work by restraining demand and holding down inflation. So is he now worried that animal spirits will lead to more spending and higher prices, aka more inflation, ? Apparently not, from Jerome Powell's speech today. Now, this is the problem with Powell, that he likes to speak with both sides of the mouth. Although, the only disagreement that I got with Bianco here is that, to me, Jerome Powell was clear. He said that the Fed would not hesitate to raise interest rates again if warranted. He also warned that rate cuts, you guys are way ahead of yourselves right here. Federal Reserve Chair Jerome Powell on Friday kept the possibility of another interest rate hike in play this year, despite cooling inflation. It would be premature to conclude with confidence that we have achieved a sufficiently restrictive stance, or to speculate on when policy might ease, Powell said. He also added that we are prepared to tighten policy further if it becomes appropriate to do so. Well, obviously, the market doesn't really believe Powell. They're fighting the Fed. They say, Powell, you can say whatever you want. We don't care. We know that you're going to cut rates sooner than later. You're just playing this game because you don't want us to buy the market before you cut rates. You don't want us to go crazy before you cut rates. Once again, the problem that the market doesn't realize, interest rate cuts is not good. It's always a warning sign that the economy is slipping into a recession, because the Fed doesn't cut rates when you have an inflationary episode, when you have inflation at the core CPI at least, double the inflation target by the Fed, double. It is almost impossible that the Fed will cut rates without something wrong happening in the economy. Case in point, let's go back to the GFC episode. What you're looking at right now might be a little complicated, but let's take it one step at a time. In green, the federal funds rate. In blue, the CPI. In red, the unemployment rate, and of course these shaded areas in white, they highlight recession periods. So let's go back to the aftermath of the dot-com bubble. The bubble shifted from technology and internet stocks to the housing bubble. We began to see that the inflation rate moving higher, as you can see in blue. The Fed responded, as you can see in green, by raising the federal funds rate higher all the way until we got to what? The summer of 2006. We began to see bad news coming out of the housing market that some mortgage companies, some lenders who got into bad behaviors such as subprime lending, began to see signs of stress and laying off employees. And there were concerns about, hey, maybe the Fed is doing too much here. Maybe we're seeing enough damage in the economy. So comes the summer of 2006, as you can see in green, the Federal Reserve decided to pause interest rate hikes. At the same time, the Federal Reserve policy was higher than the inflation rate in blue. So this is how we know that we are in restrictive stance, and this is why inflation went down. In the period when inflation goes down and the Fed funds rate is paused, remains flattish, and the unemployment rate is not rising, as you can see in this period right here, 2006 into 2007. This is where we see the light at the end of the tunnel fallacy happening. This is when we begin to hear Goldilocks, soft landing, as we hear right now, because Fed is not raising rates anymore, unemployment rate is not rising, and oh, by the way, inflation is going down. But then the lag impacts of the Federal Reserve policy raising rates began to show up in the economy. We began to see the unemployment rate rising a little bit higher. A lot of these subprime mortgage lending companies began to blow up. We began to hear about a lot of problems in lending in the economy and credit restrictions. So notice that the Fed paused interest rate hikes in the summer of 2006. When did they begin cutting rates? The answer is September of 2007. That's when the Fed began cutting rates. Over a year since the pause. So all of this talk that we're hearing about, oh, the Fed is going to cut rates by March, you better hope that that's not going to be the case, because if it happens, it will happen for the wrong reasons. Here's the other problem that we face when we talk about the dual risk. Notice that when the Fed began cutting rates, what happened to the blue line? It moved higher again. Inflation came back because the Fed cut rates. And we all remember what happened in the summer of 2008 when gasoline prices almost reached $150 a barrel. At the same time, the unemployment rate was also rising. So for all of you who say Maverick, you can't have it both ways. Our unemployment rate moving higher and also inflation coming back. Yes, you can. The dual risk, 2008. And then we hit Lehman and the economy crashed. Inflation crashed down to negative. Unemployment surged significantly higher. And then the Fed cut rates all the way down to zero. What do we see right now in the episode that we have? Unemployment rate ticking a little higher. The Fed policy, the green line, is above the blue one, so we know that we have a restrictive stance right now and inflation is going down. And we have a pause since the summer at least. Fed rates did not move higher. So now we are in the Goldilocks / soft landing / light at the end of the tunnel fantasy. The problem begins if the unemployment rate begins to move higher, then the Fed will cut rates. But the problem is, as they cut rates, will we see inflation coming back? And I would say that the inflation pressure that we have right now in this episode is a lot stronger and more sustainable than the GFC episode, which means for certainty, inflation will come back. And then what? You have unemployment rising higher, inflation moving back up higher again, and the Fed may be cutting rates, but it doesn't matter. And this dynamic will lead us to the same exact destination that we got back in 2008. Something will blow up, economy is going to crash into a recession, and the stock market will flush down and lose 50% or more of its value. Let's see how the market reacted, though, step by step in the GFC episode. Here's a chart of the S&P 500 weekly chart. As you can see, summer of 2006, the Fed paused. The moment the Fed paused, we saw a rally in equities that is worth about a little over 25%. So we see the market getting excited. The light at the end of the tunnel, soft landing, Goldilocks. I know what you're going to say right now. Maverick, are you saying that the market is going to rally from this point on, just like we've seen back in 07? Are we right now in late 06 going into 07? Hold your horses. I'm going to show you another piece of evidence that suggests that we're perhaps in mid to late 2008, not late 2006, early 2007. Hold your horses. And then what happened? The Fed began cutting rates in September of 2007. Why? You can see the stock market went down. We began to get really bad news about the economy. As the Fed began cutting rates in September of 2007, notice the overreactions here, the drug addict mentality for the stock market. We see the market up once again by almost 15% just because the Fed announced cuts. So what we see right now in the market that we have today, all of these impulsive rallies, that is not unusual. Not at all. Then what happened? As the Fed began cutting rates, we began seeing inflation moving higher again. So the Fed reduced the rate of cuts from 50 basis points to 25 basis points, and the market began sliding down. Then what happened? The unemployment rate reached over 5%, and we began to slide down even more. Then the Fed said, okay, now we got to cut more. So they raised the degree of cuts to 75 basis points. The market rallied a little bit, but it didn't matter at that point because we all knew that we have severe economic weakness here, that it could lead into a recession. Matter of fact, at that time, folks were already talking about the economy being into a recession already. But it doesn't matter. The Fed cuts rates by 75 basis points. We see a rally in equities within 2 weeks, worth about 10%. Then what happened? We got the collapse of Bear Stearns. But after that, JPM rescued Bear, and everybody said, okay, we're out of the woods. So far, so good. The market rallies again, overreacting by about 15%. But remember, we have the dual risk here. So as the Fed cuts rates to combat one risk, which is the recession, the other monster shows up, the other risk, which is inflation. So why did the rally top here in 2008? The answer is, we all remember the big short covering rally in oil when oil moved to $150 a barrel almost. Now, at the time, folks would say oil prices are going higher because of the Bush administration, because of Saudi Arabia not pumping a lot of oil. Bullshit. It was a short squeeze. A lot of folks shorted oil, assuming they were heading into a recession. But when the Fed cut rates, they were forced to squeeze. And we saw a massive rally. And with that, since oil came back, inflation came back, and equities went down. They only bottomed in the summer of 2008 when oil prices stopped. Then we saw another overreaction with the stock market rallying and rebounding by about 10% or so. And then we got into the month of September 2008, and the lag impacts all along caught up with us, and one of the biggest financial firms at that time, Lehman Brothers, collapsed. And that was the nail in the coffin, and the rest is history. What is the lesson from all of this? You could place yourself back in 07 or even 08 and say that because we're rallying right now in this rally that I see at that point, particular point, 9%, 10%, 14%, that we have a bull market, Jack. And Maverick, you're a perma bear. You're wrong. But you look at the big picture of what happened in the GFC, and you cannot assume that we're out of the woods, because the fallacy that we have right now is the same fallacy that took place back then. And I know what you're going to say. You're going to say, but Maverick, what about the GDP? The GDP is moving higher. Well, the GDP even before the crash in 2008 was also pretty good. The GDP is the most irrelevant number in economic history. It doesn't matter. It's easily manipulated. If you raise debt, if you spend more, GDP goes higher. But it doesn't really tell you anything about the health of the economy. And by the way, according to the Atlanta Fed, the next GDP will crash down from over 5% all the way down to barely 1%. So the GDP is not something you want to put your eggs in that particular basket and just depend on the GDP number that we have a good economy. What you should be looking at is the unemployment rate. And we told you before that when the unemployment rate moves higher in the economy, it happens really fast. You almost can't really wrap your head around it. And the latest example, of course, would happen in 2020. When the unemployment rate surges higher, you go from one reading that was 4.5%, pretty good, nothing's happening, a little bit higher than usual, but okay. Then you go to 4.8, next thing you know, 5.2, then 5.8, then 7%, then 10%. It comes really, really fast. So you have to look at the leading indicators to the unemployment rate. What are we talking about here? We talked about in the past episode, or not the one before, I should say. We talked about continuing jobless claims. That's moving higher, and that's a leading indicator that the unemployment rate will also move higher. We also have to look at job openings. We see sharp declines, as you can see here from Games of Trades. You see a sharp decline. That is a leading indicator that as job openings go down, we will also see the unemployment rate moving higher. Another warning sign, and we go back to the question that, hey, Maverick, isn't this 2007? Are we heading into 24 as 2007? We have a double digits rally. Possible? Sure. But listen to this here, and you'll understand that maybe we're closer to 2008 than 2007. The headline from Reuters, November 2nd, 2007. Wall Street's narrow leadership spells trouble. What are they talking about? Here it is. Equity analysts worry that a rally underpinned by a declining number of stocks tend to be more fickle and prone to messier pullbacks. Indeed, come November 1st, U.S. stocks found themselves on a retreat, with 4 stocks falling for every one rising. By midday on Thursday, the S&P 500 was down by about 1.4%. The strategist from Stifel at the time says, "It reminds me of the late 98-99 period. We were calling it a bull market because the gainers were big cap names that helped move the indices, but it was not sustainable." Sounds familiar? One warning sign, the analyst noted, is that half of the components in the S&P 500 are trading below their 200 days moving average, a negative technical indicator for those shares. Another sign of trouble is the steady fall off in the number of stocks rising on a daily basis. Well, gee, doesn't that sound familiar? Because throughout the year 23, we've been seeing the rally pretty much led by a handful of names. Recently, we've seen a lot of short covering because of the light at the end of the tunnel fallacy, which folks assume, oh, we have peak rates, nothing is going to happen here, I got a short cover. So we saw some improvement in breadth in the last couple of weeks. But the theme all along has been it's the big caps, and the rest of the market is crashing, continuing from 2007. Despite the growing ranks of decliners, sharp gains for stocks such as search engine Google and Research in Motion, if you remember that one, Apple, Microsoft have kept indices above water. Each of these stocks rose more than 20% in October, and combined, they have added $154 billion in market cap in the month. By contrast, the entire S&P 500 rose $185 billion in value during the month of October. Google, Microsoft, Apple, and Research in Motion, that's the equivalent of Nvidia, by the way, all reported earnings that blew away Wall Street's estimates and made upbeat comments about the quarter ahead. Still, their stocks' swift gains are not just a function of earnings, according to traders. This is really important for you to understand. Guys are not out there buying them to hedge their portfolios. They are trading mechanisms now. It is the momentum trade if you want to get long. They will throw them out tomorrow if the momentum goes south. But as long as the trade works, they'll keep doing it. They've racked up enough gains, they can't take on the risk. In addition to fast money traders, more conservative portfolio managers may also be getting swept up in the feeding frenzy surrounding big cap tech. Folks, does it sound familiar or what? Okay? Just so you understand that you could be in the fallacy right now. Oh, bull market, we're going higher, but you don't understand history. 2007, 2008, SPX, the S&P in green, NDX, NASDAQ, technology in orange, IWM, small caps in blue. The S&P was up about 4%. The IWM was negative. The laggard, technology was the gainer. NDX was up over 17% for that year. Sounds familiar? Now watch what happens if we plug in Amazon, Apple, and Microsoft. Boom. Microsoft outperforming by 20%. Apple for that year was up over 130%. Amazon was up by more than 140% for that year. And we all know how the movie ended. So you being seduced by these rallies, but not understanding history, it's going to come back and bite you right in the ass. And oh, by the way, if we have the roaring 20s, as the pumpers say, or we have this Goldilocks, or we're out of the woods and we have a soft landing, explain to me why the executives, the CEO, the C-suite is dumping shares like never before. They keep telling us to buy Nvidia, but the board of directors sold 13% of her Nvidia shares, totaling $5.25 million. And we know that CEO Jensen Huang, he's been dumping like crazy, and he's going to dump even more. Zuckerberg of Meta, he's also dumping hundreds of millions of dollars worth of shares. ExxonMobil, the board of directors, also dumping his entire stake, worth over $215 million. The Walton family of Walmart, they've been dumping like insane too. Why do they keep telling us to buy and they cash out? That is something you have to think about. Now, the last thing I want to talk about is this chart right here that I published on Twitter, which you can see the correlation for 23. Stocks go up, crude oil goes up. Stocks go down, crude goes down. Until recently, month of November, we've seen stocks going up, but crude going down. And I said one of them is right, only one. And if it is crude that is predicting a recession, then stocks are wrong. If stocks are right, then we have a historic opportunity here in buying crude oil. But let's go back to what happens when the Fed cuts rates. The last example in the GFC, when the Fed cut rates, we all know what happened to the price of crude in 2008, the insane short covering squeeze. So when you talk about rate cuts, it's not just that they happen for the wrong reasons, but because of the dual risk, they could also cause inflation to come back with aggression. And the reason is, as we get recessionary news, traders position themselves in a way, and back then they shorted oil, as we see right now. And then as the Fed cut rates, they got squeezed out and they had to buy back. We saw one of the biggest squeezes in history. Now, we got the OPEC Plus meeting this week. We got the cuts by OPEC Plus, but the market didn't really believe it. The market said, yeah, you're cutting, but the cuts are not really big to make a dent here in the rise of production by the United States and countries like Brazil. So Saudi and Russia can cut, but so long as the US and Brazil, which by the way, joining OPEC right now, if they keep increasing the production rate, then it wouldn't matter. Prices will go down. Now, Russia has more of a diversified economy. They rely on oil, but they have a more diverse economy than, let's say, Saudi Arabia, which is more than 90% reliant on oil. Now, Saudi is cutting its own production, meaning they make less revenue. They expect that the price will go higher, so they will make up for that. This is not happening though. Prices go down, and they're producing less, meaning their economy will be in wreckage. And just like we talked in the economy, we have the dual risk of recession versus reinflation. In the oil market, we have dual risk. Either oil prices will crash dramatically, as we've seen in 2014 and 2020, or we have the mother of all short squeezes coming. Let's begin with scenario number 1. The headline reads, Saudi Arabia could flush the oil market with a flood of supply to regain control over prices in the face of rising U.S. production, crude expert says. What are they talking about? Here it is. He estimated that Saudi Arabia has the capacity to ramp up its output by an additional 2.5 million barrels per day. For now, OPEC's de facto leader is trying to prop up crude by pumping less. On Thursday, it extended its cuts of 1 million barrels per day into the first quarter of 24. But Sankey, this is one of the top oil analysts in the world, noted that Saudi Arabia shocked the market in 2014 when it similarly tried to flush the market by sinking crude prices from highs of around 110 to $50 a barrel. Why did they do that? Here it is. The drop in prices eventually forced higher cost producers to exit the market as pumping was no longer profitable. You see, back then we had the shale revolution and Saudi said, okay, watch this. We're going to flood the market with supply like you've never seen before. Prices went down. The shale oil producers were underwater and eventually they shut door. They're out of business. Meanwhile, Saudi, it's a low-cost producer. They bit the bullet. It was hard for them, but they won at the end of the day. They drove shale businesses out of business. And in the case of 2020, they forced Russia to comply with the cuts. Anyhow, meanwhile, Saudi Arabia continued to pump as it was better able to withstand lower prices, as supplies from its rivals disappeared. The kingdom was able to regain traction over prices. Back then, like today, booming U.S. oil supply is a headache for OPEC and Saudi Arabia. And Sankey said Friday that oil cartel has a huge problem with U.S. production levels. In fact, U.S. crude output has been on a tear this year, with monthly production hitting a record high in September at more than 13.2 million barrels per day, according to the EIA. Now, so we talked about one side of the risk, which is what happens if oil prices crash. By Saudi flooding the market by supplies, they can increase production right now by over 2.5 million barrels. And if they do that, oil prices will crash. The shale producers here will face the same problem from 24, and other OPEC countries will also get hurt. Here's why I think that this scenario is less likely. If Saudi does that, they already did that back in 2014. And it did work back then, but now we see that the shale producers and U.S. production all in all came back. So suppose they do it again. There is no guarantee that they're going to drive the oversupply problem out of the market because they can hurt shale producers, high-cost producers here in the U.S., but they're not going to hurt, let's say, lower-cost producers in Russia, in Brazil, and Africa. So all what Saudi will achieve from this move is losing market share, and there is no guarantee that it's going to work. The other problem with it right now is Saudi has a lot of problems in diversifying away from oil. They need a lot of money right now. They need prices to be above $80 a barrel to achieve their goals of moving away from oil revenue from 90%, let's say, back down to 40 or 30%. So they can't afford to do this move again. What about the upside risk, though? When you look at the short positioning right now in oil, it is the highest in history, meaning that if we go back to the episode of 2007-2008, when the Fed began cutting rates and we saw the short squeeze in oil, can we see it again? The answer is yes, and this time it's going to be even bigger than 2008. Would cutting rates by the Federal Reserve alone achieve the squeeze? Maybe, if it happens prematurely, if it happens without bad news. But what if it happens, bad news or no bad news, yet we have another trigger here that causes the short squeeze? What are we talking about? We are talking about the geopolitics. So we know that the war in the Middle East is not over yet. And I know a lot of you say, Maverick, you're crazy if you assume that Saudi will do an embargo. Watch. Do they have another choice? If they do it with coordination with other Arab countries, and let's say Iran, maybe some empathy cuts by Russia, for example, we're going to see oil prices at 150, if not even above 200 rapidly because of the short squeeze. But okay, let's say that this is a far-fetched scenario. We got the headlines this week that maybe we're going to see a war in South America, with Venezuela threatening to invade its oil-rich neighbor, Guyana. Now, you might say, Maverick, what do I care about Venezuela and Guyana and all of that? A war like this between two oil-rich nations will definitely force a short squeeze in the oil market. Not going to be the mother of short squeezes, not going to be the big one. It's going to prop up the price of oil back above the 85 level in Brent, at least. But another threat when we talk about the Middle East war is the breaking news that we got today. Take a look.
A very good day to all of you from the Tom Brokaw News Center here in Los Angeles. Welcome everyone to Alex Witt Reports. We are beginning with breaking news. A U.S. warship has come under attack in the Red Sea. Pentagon officials say they are aware of drone attacks on the USS Carney and commercial vessels. It happened earlier today.
So if you look at the map right now, a huge part of international commerce, but specifically the shipment of oil, take place from two important destinations, the Strait of Hormuz. Then you have another entry right there in the Red Sea crossing Yemen. Well, guess who controls these two outlets? The answer is Iran. So Iran controls the Strait of Hormuz. Iran, via its proxy, the Houthis, is now controlling entrance into the Red Sea. And if this war escalates in the Middle East, we see the involvement of Iran via proxy or face-to-face with the U.S. Navy. What do you think Iran will do? They will close these outlets. And this is why we have a huge number of ships right now in that particular region. Because we know if Iran does that will cause oil prices to shoot up significantly higher, way above $200 a barrel, from a short squeeze alone. Bottom line, folks, if you think that we're out of the woods, think again. I just presented you with the geopolitical risk in the oil market, number one, and presented you with the fallacy of soft landing, Goldilocks, light at the end of the tunnel, exactly the same way we've seen before the GFC and the crash of 2008, 2009. The dual risk is now real, and all what we see right now is the quiet before the storm. Which risk will eat us? Is it going to be the recession risk? And then the cuts by the Fed will happen because of that? And even if they do, will the other risk come back into the picture? Reinflation. Or will the Fed cut prematurely and announce mission accomplished, and now we have the risk of reinflation coming back? We are not out of the woods and making assumptions based on overreactions in the meantime without looking at the big picture is a big, big mistake. Anyhow, let's expand the conversation here, folks, and cover the market activities this week. And we begin with the closing of the indices, and here we go. On Friday, the diamonds were positive 294.61 points, or a gain of 0.82%. The Nasdaq was in the green, beat the laggard, with 78.81 points, or a gain of 0.55%. The S&P 500 in the green by 26.83 points, or a gain of 0.59%. And small caps, the Russell 2000, the winner of the day by a mile. Massive squeeze in the Russell 2000 here, up by 5.25 points, or a gain of 2.92%. The sectors on Friday all positive, led by real estate, yield sensitive, materials, dollar sensitive, even though the dollar rebounded, but it took a pullback on Friday. Of course, materials is moving higher because of the strength of gold. That's defensive, that's not risk on. And then we have industrials. We have certain names such as Boeing outperforming by a lot, so we see that in number 3. The laggard on Friday, comm services. We saw pullbacks in the big caps, Meta, Google, and Netflix was also an underperformer. If we contrast this with the performance for the week, it's pretty much the same picture here. REITs number 1, metals number 2, industrials number 3 in the laggard. The only sector in the red deeply is comm services once again. If we look at the breadth on Friday, pretty good. The big caps were down, but the rest of the market, specifically the small caps, the heavily shorted names, caught a major bid. So we see the NYSE 87% advancing versus 12% declining. The Nasdaq 76% advancing versus 22% declining. So we see 87 advancing in the NYSE. You got to go back to neutral in Monday's session, perhaps into next week. We go back to the 50-50 neutral line, and then we see what happens from that point on. On to commodities. What do we see here on Friday's session? We see that energy down across the board. Disappointment with the OPEC Plus cuts. But as we talked about in the intro of this video, that we will see now the Joe B administration refilling the SPR. So that's a positive catalyst. The tensions in the Middle East, not over yet, but I would not buy oil based on that alone. That's going to be one of those catalysts that when they happen, they're going to force a short squeeze in the market, and then you can ride that wave. But just buying oil right now based on that assumption alone, you're going to face the headwind, which is stronger at the moment, and this headwind is a recession. So I would not be surprised to see bounces and rallies in oil. But the sustainability, when we talk about the dual risk, the sustainability in face of recession is doubtful without something big flaring up a short covering rally, such as the geopolitics. When we look at softs on Friday, sugar was the loser for the week. Nothing different here on Friday's session, down by more than 3.5%. OJ pulling back a little bit here by about 1.5%, and cocoa similar decline here, although OJ and cocoa been on a tear recently. So all of these drops are just drops in a bucket. A little bit of weakness in cotton futures, which been weak throughout the week. Although coffee, the party boy, coffee futures, the winner for the week, pulling back a little bit on Friday's session. We will look at metals. So you got the risk-on metals, copper, surging on Friday's session by about 2%. This is again the fantasy of, oh, we're out of the woods. We have to go with the cyclical metal here, copper. But the defensive metals, gold and silver, also moving higher, so one of them will be right. Is it the defensive theme that we're heading into a recession and economic weakness and you gotta be with gold and silver? Or we are heading into an expansion mode and the worst is behind us and you gotta go long copper? We'll see who wins at the end of the day. Meats down across the board, be it lean hogs, feeder cattle down over 2.5%, live cattle down a little over 1.5% on Friday. When it comes to grains, soybeans down across the board, be it meal, be it soybean oil, doesn't matter, all down. Oats was the winner, up a little over 4.5%. And wheat, we see a little bit of a movement here in wheat. We have no confirmation yet that we should be long wheat. We're getting close, but we need to wait for a confirmation. If we look at the performances all in all for the week, as I said, coffee, the party boy this week, up almost 10%. Not good for Starbucks, so you see the stock for Starbucks down. Then we have, of course, silver, wheat, gold, the outperformers for the week. Cocoa down on Friday, but up for the week all in all by about 3%. The laggards, natural gas, big retreat, worth a little over 7%. Then you got palladium, sugar was a loser, and of course lumber. Lumber down almost 5%. And lumber has a great correlation with the stock market. When it rises, it predicts a move higher in the stock market. On the other hand, when it drops down, it usually leads a drop in the stock market, so we'll see if that's going to hold or not. On to the big casino, the options market. What do we see here? Believe it or not, the volume is still low, so we don't see participation by the retail mom and pops in this rally. Let's say meaningful participation. I will show you why in the charts analysis, because believe it or not, the gains from November all the way till the end of this week happened in 5 days. Either you were a participant in these 5 days or you missed it. And I think the majority of retail mom and pops missed it. So now we see the mom and pops throwing a dart here, throwing a dice here and there with low volume, buying way out of the money calls, betting that these rallies will continue. So we see the volume down, but we see the ratio of calls versus puts exploding higher. We're talking about the 60s now. In certain cases, such as Alibaba and Palantir, we see them in the 70s. SoFi, over 75% of the spread calls. That's not sustainable. The puts are becoming really, really cheap. The calls are becoming really, really expensive. So the dynamic is going to change here. We're just waiting for a trigger. And so far, the triggers that we thought might be the one did not play out. But this week, we have the jobs report. Then we have the CPI. Then we have retail sales. Then we have the FOMC. So we have plenty of catalysts here that could be the excuse to book some profits from this rally and shift toward puts away from calls. At the same time, when we have the fallacy of the soft landing and, rates are going down, nothing is going to happen to the economy, you better cover your shorts and all of these systemic risk plays, we see massive squeezes, specifically on Friday, massive squeezes, because a lot of hedge funds who are short these names, they got to cover at some point, if that is the assumption. Whether they believe on it or not, they have to. So what they do is they sell the big caps, which they're long, and they use the money to buy these small caps and heavily shorted names. So we've seen squeezes on Friday because of that, the rotation from the big caps to the smaller caps. We've also seen a lot of insider trading here. A lot of folks getting ahead, knowing stuff before it happens. Somebody flipped $70K to over $1.3 million betting on GameStop to squeeze. Another one bet on AbbVie, buying another pharmaceutical company, and they got it right. They made millions of dollars. So we have a lot of games being played here. Where's the SEC, you might ask? The answer is the SEC is in a coma. Now, when we talk about the short squeezes, I also see a lot of bullish activities, a potential for a squeeze in Roblox. So keep an eye on this chart right here. It might squeeze big. Just keep an eye on it. When you want to chase these squeezes, don't go with the ones that already played out, because if we have a short squeeze phenomenon in the market, then a lot of other charts will play out too. So you want to look at RSIs that are not really overbought right now, but could become overbought and could force bigger squeezes. So in addition to Roblox, you have Unity Software. We talked about this earlier in the week. We had a bull flag pattern, and now it's playing out. So keep an eye on these names. What you don't want to do, though, is chase the squeezes that already happened, such as GDDY. This is GoDaddy. Look at this. Defying any technical analysis book. Nothing will teach you this. Why? Because we have a big short squeeze phenomenon here. If you bet on it, if you buy calls now out of the money, you better get another 5 to 10% move to the upside to make your money. Or if it goes up by 1% or 2% or drops down, you're done because you're overpaying right now. The implied volatility for the stock is really, really high. And it could be the same way too. You look at the chart and say, Maverick, this is going to go down. This is going to crash. So you buy the puts, but understand this. The implied volatility is really, really high. What does that mean, implied volatility? It means that the market maker is assuming that the moves from this point on will be really big, to the upside or the downside. So they increase the premiums that you and I pay for these options. If you buy the puts right now, your timing is wrong and the stock keeps squeezing higher, you're gonna lose. And if you get it right and the stock goes down, but not by, let's say, 10, 20%, you probably overpaid for these puts. And if the stock goes down by 3%, you're not gonna make money. So you're better off looking for lower implied volatility that is increasing, not higher implied volatility that could decrease. Enough said. Anyhow, let's move on to the unusual activities that took place in the options market on Friday and see what they're buying here. We begin with the ticker CCJ. This is for Cameco. We own the name in this channel as a uranium bet. To my eye, the chart looks toppy, but somebody here sees that the stock might go higher. Now, be careful if you're going to follow this trade. The spread is really wide, so you might want to pick another option here. They bought the 53 calls for the expiration date December 29th. Expectations, Cameco will move higher and gain more than 17% by then. They paid about 50 cents a piece. Tenor. This trade, all in all, spending about $1 million. The spread is really wide, so pick another trade here if you believe that Cameco is going higher. I disagree. I own the shares, but it looks toppy to my eye. Although we have this climate conference or whatever, and they talked about increasing uranium and increasing the use of nuclear energy. So that could be a positive catalyst here. Then we have the ticker BE for Bloom Energy. The stock is getting squeezed. It was up over 6% in Friday's session alone. And somebody's betting here for more gain to come. They bought the 17 calls for the expiration date, January 19th. The expectations, the name will pop higher and gain more than 10.5% by then. Paid about 80 cents a piece. Tenor. This trade, all in all, spending about $650,000. And then we have the Uber trade here. I'm going to pass on that, but somebody again always knows what's going to happen. And they bought the calls, 61 calls. Guess what happened after the close on Friday? Uber is going to be included in the S&P 500. The stock pops by more than 6%. Now, a lot of you, by the way, asked me on Friday on the stream, should I short Uber? It went way too high. Maybe I should short it right now. I said, nope. Hold your horses. No confirmation signal yet. Be careful, and you're probably glad that you didn't short it. Anyhow, we have DKNG, DraftKings. Another call, another name that could squeeze a little more here. Somebody bought the 43 calls expiration date January 19th. Expectations, the name will pop higher by more than 10% by the expiration date. Paid about 90 cents a piece. Tenor. This trade, all in all, spending about $650,000. Then we have the ticker DOW for Dow. Dow Chemicals. Also a name, if you look at the chart, it's a bull flag that is playing out. With the dollar going down, if you think the dollar will go down even more, this one could play out. So here we have somebody who bought the 55 calls, expiration date February 16th. Expectations, Dow will go higher by more than 5% by then. Paid about $1.30 a piece. Tenor. This trade, all in all, spending about $1 million. You see the calls for Roblox. We're going to skip on that, but they're buying a lot of them. A lot of speculative calls on Roblox. Keep an eye on that name. But then we have USO. This is the U.S. oil funds. We talked about that we bought it because of OPEC Plus. That was a disappointment, but could the refill of the SPR at least produce a short mini squeeze? Perhaps. Somebody bought the 76 calls for the expiration date, January 19th. The expectations, the name will pop higher by more than 10% by then. Paid about $1 a piece. Tenor. This trade, all in all, spending about $600,000. On to the heat map on Friday. What do we see here? Of course, the obvious news came from Pfizer. Pfizer is a dead dog. You can't buy the stock. It is broken. At some point, it might play out, but they've made a lot of mistakes. They put all of their money in one basket, which is the, forgot its name, Paxlovid, and nobody wants to buy that shit anymore. So we see Pfizer down, and of course, their weight loss drug, the pills that were supposed to compete with the Ozempic, was a bust, so we see Pfizer down big. But all in all, folks, the theme is, if you go back to the template that we have, the chase trade, money's coming out, the catch-up trade, money's coming back in. Exception, of course, Tesla because of the Cybertrash. So you see on Friday the big caps underperforming Meta, Google, Tesla, Microsoft, Nvidia. Although Apple and Amazon up, we see the Ozempic mania, Eli Lilly, NVO going down, but we see otherwise, be it banks, be it biotech, be it industrials, be it metals, be it REITs, utilities, cyclicals, all catching a bit as we see this rotation going on. Now, chips are looking a little weaker now. Nvidia has been an underperformer since the earnings report came out, but Intel was hot. On Friday, we see Intel now cracking, and we see Marvell, MRVL cracking too. Are we about to see this theme expanding? We see more chip names going down. Let's contrast this with the weekly heat map and see what's going on. you're not going to find a lot of differences here. The big caps underperforming, the Chase trade underperforming. So we see that Meta down, Google down, Microsoft, Nvidia, Eli Lilly, NVO, all down. Berkshire Hathaway, of course, because of the sad news that we got from Charlie Munger. But then you look at otherwise in the market, it's pretty much doing pretty good. The catch-up trade is outperforming, including Tesla, by the way, because for the week it was up about 1.5%. But it made a little move in Friday after the Cybertrash, which could reverse these gains. So we'll talk about it in a minute here. But the message is clear, folks. Rotation. Out of the big caps, the winners, into the laggards. Another theme that we've seen throughout the week is the underperformance of Humana in healthcare, Humana and Cigna. They're merging, and mergers are not good. If it was an acquisition, okay, maybe we've seen one of them moving higher, but a merger is not good, not just for the investors, but not good for consumers too. We have two giant healthcare companies merging together. Now they have bigger pricing power over us. I don't know how this is going to pass. But anyhow, let's contrast this with the weekly heat map for the ETFs. And once again, we'll look at the TLT right off the gate. TLT up by about 3.5%. It means that yields went down, although they looked pretty good as we headed into the week, that we could see a rebound in yields, but instead we went down. The question now becomes, are we about to see a rebound in yields this week? I think that we have one more pop in yields as a reminder that it's not over. And then in 24, we get the deluge again by Janet Yellen, and that's going to be a problem when we get there. But for now, since yields are down, right off the gate, we see yield-sensitive ETFs blasting higher. Whether you look at KRE, which is regional banks, up almost 7%, IYR, real estate, up big for the week, XRT, retail, high debt, also up about 5%, XBI, another high debt, up a little over 5.5%. Then we have XHB, home builders, ITB, construction, all moving higher. The problem that I see here, folks, is that we're only pumping them higher because of the algorithmic reaction. That all bond yields are going higher. We have to pump money into these sectors. But what about the economic weakness? So I see these ones in particular here at risk. XLF, financials, KRE, regional banks, XHB, home builders, ITB, construction, XRT, retail, IYR, and all real estate ETFs. I think those are moving higher because of the algorithmic reaction without thinking about the economic risk. And once we get data about economic risk, they pull back big. I think the XBI has a better chance, a better case, that it's not been moving higher just because of bond yields going down. I think we have attractive valuations in biotech, and I think it already paid its due. It went down big, but it's not part of the systemic risk case here. It's not the KRE, regional banks. It's not real estate where we could see a collapse of office REITs or commercial real estate. It's not part of the systemic risk in home builders if the construction / the housing mania comes down. We're seeing a lot of data indicating that the housing mania is slowing down dramatically. It's not part of the systemic risk in retail stores, where we see earnings coming out really bad. So the XBI has a better case over the rest. Now, as we said, since on Friday we saw some short covering in the small caps, rotating away from the big caps into the small caps, we see that the IWM and even mid caps, MDY, Value, VTV, all outperforming large cap technology growth, IWF, VUG, XLK, SMH, all laggards for the week. And the hottest trade remains the GDX gold miners, gold, GLD, SLV silver. But what happens if the dollar indeed rebounds in a sustainable way? What would be the reaction here? If gold and silver hold, we know that we are indeed shifting into a defensive theme, that there is a corner in the market saying, watch out here, folks. You're getting too excited. But the real trade should be in gold, silver, the defensives, because we're heading into a recession. For more color on that, let's do the charts. And we begin with the SPY, the S&P 500. An hourly chart, what do we see here? On Thursday, we talked about the risk of this being a wedge pattern that could break out. And indeed, on Friday's session, it did break out and got us all the way to the highs from July at 459.44, but it did not close above. Now it's forming a bull flag pattern. Is it going to play out? Is it not going to play out? Let's zoom out a little bit here. Throughout this rally, we got a few days, big pops, and then we consolidate for a little bit, and then we pop higher again. So the recency bias would say, yes, it's going to play out, and higher we go. And we have no confirmation of a reversal right now until we take the range of one of these consolidations. And to me, and I've been saying all week, folks, the confirmation for any reversal in the SPY is losing 453.58. If we lose that, then we can talk, okay, the trend is now changing. We're going to go down and fill some of these gaps below. Daily chart in the SPY, you can see that despite the fact that the RSI is really bloated, the MACD is about to change momentum. Got it. It's all clear. But we're back at the highs from July. Double top, sure. But until we see a sign, a confirmation of a reversal here by losing one consolidation range, losing 453.58, closing below that number by the end of the day, we cannot say that we have confirmation for a reversal here. And last week, we played the Fibonacci retracement, but unless we have a clear top by losing 453.58, the range will be expanded. When we talk about the retail participation in this rally, let's clean up the chart here a little bit. We knew that we have a reversal process Wednesday after the FOMC when Jerome Powell came out. So some folks got into the market here because they're covering from shorts since the summer or September or October. Some got in because of the technical indicators. The RSI was oversold. We were below the Bollinger Bands. We talked about that back then. Some of these traders got lucky and they got the rally from the get-go. Did they hold all the way till we have today? I doubt it. I think a lot of them got out early too. But for the majority, when you look at the gains in this rally, they happened in 5 days. Either you're a participant in these 5 days or not, or you just got caught in consolidation. And a lot of managers did not capitulate until, let's say, day 1, day 2, day 3 were over. So if we have a pullback, even if it is as shallow as, let's say, 1.5%, 2%, a lot of managers will be underwater really quickly. So this is why I say that after a rally like this, the rush to the exit door, the pullback process, the higher you go, the bigger the pullback. Why? Because we see a lot of recent entrants to this rally, be it retail, be it managers, rushing to the exit door really quickly at the same time to lock in their gains, and that causes a big flush down. But until we lose at least one consolidation range, folks, we still have no confirmation. Let's talk about the upside and downside cases. Looking at the SPX, the cash index weekly chart, what do we see here? I'm marking some of the important reactions, 1, 2, 3 from the bear market of 22. These are really good as milestones. That's the beauty of a bear market. It shows you really good resistance lines. And right now we have number 1, which is 4637.30. That could be the upside case if indeed we go higher. What we know right now is, you see the downtrend in yellow, then we have an uptrend that began in October 2022. Fed signals that we have the last 75 basis points hike. We see equities rebounding higher. Then we got the collapse of SVB, but the Fed interfered and kept the trend line intact. Then we got what? In the summer, the NVIDIA revenue increase, the AI mania. Then the Fed announced the last rate hike. That was the top. We went down in the month of July all the way down to the month of October. We broke the trend line, but we did not break the important reaction at number 2, 4114.65. So for a lot of folks, this was a bear trap, and it was part of the other reaction that followed, which is a short squeeze because of the Fed rate cuts optimism. Again, if we go back to number 1, the resistance line that we have next here, 4637.30, that would be a gain of about, let's say, 1% or so. If we go down, what is the case here? The case is that if you take the upper reaction since the reversal and then the reversal to the upside, you take the bottom of that, we have what appears to be a rising wedge pattern. And if we get a catalyst that negates the story, that highlights the dual risk, watch out, folks. You might not see the recession risk yet, but what about the inflation / the higher yield risk? That is still here. If we get any evidence of that, then this rising wedge will play out, or we can go down to the 20 weeks moving average of support that would be in or around, let's say, 4,400. If we look at the daily chart for the E-mini futures, what do we see here? Throughout the week, folks, we talked about 44.75. We got no confirmation for a reversal until we close below that line. Number 1. Number 2, we talked about the wicks. If you take the wicks out, we have a bull flag pattern, and it could play out. And it did play out on Friday. Now, do you assume by default that we're going back to 4634.5, which is the previous high from the month of July? That is the assumption for now. But understand that with an elevated RSI and MACD reading right now, that is reversing. Any bad news for the market, not necessarily for the economy, but bad news for the market, flush us down big without reaching the destination of 4634.5. But your confirmation to short, to play a reversal, to play the other way around, at least you got to see a daily closing below 44.75. The Qs, the NASDAQ hourly chart, what do we see here? Notice that the Qs was the laggard on Friday's session. And throughout the week, because of the lag in the big caps were the leader to the rally. Now we see them lagging and perhaps leading to the pullback. But you need to see a confirmation. What are we talking about here, Maverick? We're talking about we have a pattern of higher highs. Do we have a pattern of lower high now? How do we know? Confirmation losing and closing below 388. Then we have a confirmation of a lower high, and okay, the Qs is topping and going down, and next thing you know, perhaps the others, SPY, IWM will follow too. Daily chart for the Qs, what do we see here? Now, with an elevated RSI and a reversing MACD indicator, the risk is that you see somewhat of an island reversal here. What are we talking about? We wake up Monday, wake up Tuesday, and we have a gap down, and we leave this consolidation range that's been going on since the middle of the month of November. We leave it hanging over there. We've seen that before. Here it is. And that was the top in July. The top in July after the gap, produced losses of over 7%. Of course, then we got a bottom because we got outside of the Bollinger Bands. For all of you who say that the Bollinger Bands don't matter. Question now becomes, if we get a gap down, that would be the worst case scenario for the Qs. What you want to see if you happen to be bullish or waiting for a buying opportunity is an amicable pullback. Amicable pullback means we go down gradually, intraday, no gapping down. Then we find a good solid support, filling maybe one gap, and then rebounding as buyers show up again. On the other hand, if we have a confirmation, be it a gap down, aka the PIP2 Bismol dump, or the gradual amicable pullback scenario, it doesn't matter what it is. If we have the saucer topping pattern by forming a lower high and the confirmation of losing 388, then that would be yet another solid proof that perhaps from this point on, we mark the top of the year. We're going to go back in a pullback and then consolidate all the way till the end of the year. If we look at the weekly chart for the Qs, you notice that it's a little different than the SPY. The SPY is not at the top of the Bollinger Bands. The Qs is. This is why the Qs is underperforming. It's already did the job before the SPY. SPY is the laggard catching up. Qs already finished the move. We're now at the line of, let's say, 390.20, which is, if you go back to 22, that should be resistance number 1. And I would not be surprised to see the Qs retreating from this point on and reaching the 20 weeks moving average as support, and then we'll see what happens. If we look at the NASDAQ futures daily chart, what do we see here? Again, we talked about this throughout the week. We got no confirmation of a reversal until we closed below 15,975. Never happened. And if you remove the wicks altogether, we're consolidating in a bull flag pattern. So is the upside risk still intact in the Qs? The answer is yes, until we get a confirmation. Losing 15,975, which will be confirmed in the MACD indicator. You'll see a red impression in the histogram. You'll see the RSI moving down. Then you got a confirmation that, okay, we have a pullback. Let's see if 15,700 will hold better. If that doesn't hold, 15,500. If that doesn't hold, then we can talk about lower targets. IWM weekly chart, what do we see here? Number 1, the closing above the 20 weeks moving average. Bullish? Yes. What else? Consolidation zone. Defined highs, defined lows. If we go back to the highs, that would be a gain of about, let's say, 7.5%. Will it be that easy, though? We look at the daily chart. We have a big pop on Friday, short covering. The RSI is not really overbought right now. This is why we like the upside exposure to be in the IWM, the small caps, not the big caps and the Qs. But we're also going to stretch it a little too far here. Let's say we go to 186.49. I think it could stop here and find a pullback. But like I said, on the weekly chart, so long as the IWM is trading above the 20 weeks, not the daily, 20 weeks moving average, the pullbacks will be viable. Dixie, dollar index, daily chart, what do we see here? We got a rebound off the Fibonacci support, but we did not close the day, or let's say the week, above the next Fibonacci retracement. What we know right now, if we look at the RSI, we have a little bit of positive divergence right now. The MACD indicator is showing us that the bearish momentum is bottoming, or we're about to shift to bullish momentum. So we know that the dollar is due for a rebound. If the dollar rebounds, that's going to cause equities to pull back. The correlation is clear. The moment the Dixie rallied in the month of July, that was the top for the equities market. The moment the Dixie topped in late October and moved down from that point on, that was the rally and the comeback of the equities market. If we look at the weekly chart for the dollar, what do we see here? Again, it looks as a reversal candle for now. It is waiting confirmation, sure, but the bottom line is we got some risk here. If the dollar rebounds and begins an oversold rally, equities will pull back. And by the way, the hedge funds, they're still long the dollar right now. They did not really change their position, so that's also an interesting phenomenon. What happens to the old man gold, though? We got a tiny rebound of the dollar. Not enough to bother gold. And gold has a lot of momentum right now. Recession play, sure. Yields and dollar topping, sure. But we need to find out which one is it. Are we buying gold for the wrong reasons? Or for the right reasons? Are we buying gold because the dollar and yields top? Or are we buying gold because of the recessionary reasons? The economy is weakening and it's about to shift from one stage to the other. I think it's the latter, not the former. And the biggest test will be if the dollar rebounds. If the dollar rebounds and gold holds ground, doesn't lose a lot, maybe it pulls back a little bit because it's due for a pullback from a technical standalone, but doesn't reverse in a big way. And that would tell me that we're buying gold for the wrong reasons. The gold is now singing a different tune. Gold is saying, watch out, we got a recession, Equities say, no, we have a soft landing. We will look at the weekly chart for gold. Again, every time we have a violation outside of the Bollinger Bands in a weekly chart, we pulled back. So we know that the dollar is due for a pullback. But boy, look at the RSI, look at the MACD indicator. The momentum is strengthening right now. Gold is really strong, and I think it's strong for the wrong reasons. Same goes for the SLV silver, blasting higher. Is it a little excessive? Yes. But do we have a reversal signal? No. Until we at least erase the entire body of one candle, then we have a reversal pattern. And if it happens, folks, if you look at the weekly chart, we've now crossed above the sloping line of resistance, closing above, that's bullish, not bearish. But we're also bumping heads with the upper Bollinger Bands, meaning if we have a pullback on the daily chart, the weekly chart says the pullbacks are buying opportunities. If we look at UK oil, Brent oil, what do we see here? We got the ABC pattern played out, got us almost to 85, but then came the decision by OPEC, not pleasing the market, and we see oil reversing, now closing below the top of the reversal/breakdown candle. Bearish? Yes. Now, is it without hope? Not really, but let's go to the monthly chart here and game some scenarios. Of course, the obvious one is maybe we're playing an inverse ABC pattern. We will see oil prices down to the 60s at some point. When did we see that last? Back before the GFC. Under similar circumstances, when inflation was going down, but the Fed didn't cut rates yet, we saw that crude oil did the ABC pattern and reached the bottom of the Bollinger Bands. But then we saw the short squeeze rally. Is there a case for it right now? Yes, if we hold a lower high in crude oil and we see a catalyst, be it from the geopolitics or anything that prompts a short covering squeeze, then we could see a similar rally as we've seen back in 2008. But I think it's not going to happen right now. I think it needs a stronger catalyst, and it needs the Fed to cut rates first. If we look at the 2-year yield daily chart, what do we see here? Outside of the Bollinger Bands, way oversold here. We're going to get a rebound. We talk about the dual risk. Right now, the market says that there is no risk. Yields will go down. There is no recession. And inflation is behind us. I think we have one reminder that the story of higher yields is not over yet. We're going to get a rebound in the 2-year. And oh, by the way, in the 10-year too. Would it happen right off the gate? We anticipated one to happen last week. We got a tiny little bit of a pump Monday, but then it went down and it lost one Fibonacci retracement. Next one we have is 4.148 basis points. Can we get down there, then rebound? I think the rebound needs a catalyst, a fundamental catalyst. Hotter economic data will do the job for now. But of course, the deluge of issuing more bonds is a stronger catalyst at the longer end of the yield curve. So the Fed controls the short end. They have very little control over the long end. And the long end will be really sensitive to the issuance of bonds, which we have a lot of coming in 24. And this is why I see a lot of overreactions in the XHB, for example. If you look at the daily chart, this is an overreaction. This is just an algorithmic reaction saying, oh, yields went down, let's pump XHB higher. But we have earnings coming out from these home builders. And you will see that the data showing a lot of weakness in the housing market, even as mortgage rates go down. So I see an overreaction here, and I see that this pop is not reliable or sustainable. The same one goes with the KRE. Big pump here, Friday, short covering. But what is the sustainability of this? We know that the systemic risk is not over, and it's going to be concentrated in these kind of names. Folks, we talked about how the market does overreactions, and that presents us with opportunities. Example, on the long side, we talked about Boeing. When they crashed Boeing, that was a buying opportunity. And look at Boeing right now. Recovered all of the losses. We talked about the Ozempic massacre with health devices stocks going down, with food stocks going down for no good reason. That was a buying opportunity. Likewise, when stocks overreact to the upside because of algorithms, because of yields going down, that's going to present an opportunity to take them down, to bet the other way. So understand that these overreactions will be corrected. And I see that the KRE regional banks is also showing a little bit of an overreaction here. XBI Biotech. I think this one is more sustainable than the rest, but it's not prone to defy technical boundaries. And now it's trading outside of the Bollinger Bands. It's getting a little hot in the RSI. I would not be surprised to see a pullback in the XBI this week. But the pullbacks could be also buying opportunities. Better buying opportunities than the XHB or the KRE. If we look at Verizon, weekly chart, another yield-sensitive name. It's been pumping higher. Any reason for that? Did the fundamentals of Verizon improve all of a sudden? No. It's just a yield story. Yields go down, stock goes up. Yields go up, stock goes down. Is it becoming a little excessive here? I think so. And if we think that yields will rebound before the end of the year, at least one rebound, then you're going to see a pullback here. So I know that I'm a shareholder of Verizon. A lot of you are shareholders of Verizon. Could be an opportunity to sell some covered calls here. If we look at the VIX, the volatility index, daily chart, what do we see here? Look at the MACD right off the gate. Is the momentum changing from bearish to bullish? The answer is yes. When are we going to see the pop, the oomph? That's going to give us the confirmation that the VIX has indeed bottomed, and now it's reversing and we're seeing demand for puts. it requires a catalyst. We can speculate on which catalyst it's going to be, but I don't know. Could be retail sales, could be FOMC, could be CPI, could be jobs report, who knows? But we have a catalyst coming, which will cause a reversal of the recent pattern of VIX, Dixie, yields down, equities higher. I think we're going to go VIX, Dixie, yields going higher, equities pulling back. Big Kahuna Apple, hourly chart, what do we see here? We have a range, a channel of lower highs and lower lows. We have reached the highs on Friday's session. We can argue that this is a bull flag pattern. We're consolidating at 191.20. Is it a guarantee that we're going to break above? No. We have no confirmation that we're going to reverse the recent bullish pattern here until we lose 188.57. We go to the daily chart, you can see the range here. You can see that the RSI is in negative divergence a little bit. You can see that the MACD is giving us signal that indeed the bullish momentum has stopped. And now we're changing and shifting into bearish momentum. And the confirmation, once again, will be losing 188.57 as support. Weekly chart. Anything to see here? It shows bullish momentum, doesn't show bearish momentum, so what is the story here? Daily chart says pullback coming. Weekly chart says if you see it, and the chart holds the 20 weeks moving average, you probably want to buy it here. If we lose the 20 weeks moving average, we got a problem. But of course, we've seen this topping candle before. If we highlight that, we've seen it before. But we have no confirmation yet, even though the last one gave us the same look. Gave us the reversal pattern, but next week, the week after, did not play out. Then we got a flush down. Could it be playing out the same way right now? The answer is yes. Although the difference is back then the RSI was really elevated. MACD was reversing from bullish to bearish. Now we see the opposite. What is the bullish story for Apple? Look at the monthly chart. Are we seeing an ABC pattern here? The answer is possible. Problem is, and the importance of this chart is, if in the month of December we close below the closing of the month of November, then we have no ABC pattern, and we actually have a lower high, which is a confirmation that we're going down from this point on. Microsoft 2 hours chart, what do we see here? We talked about the bear flag pattern with the confirmation of 376 that played out on Friday's session. Microsoft was down. Now, are we seeing another bear flag pattern that would play, let's say, an ABC pattern all the way down to 367.29? Closing below that will be another confirmation that we're going down further. On the daily chart in Microsoft, you can see that 367.29 is an important line, but before that comes the 20 days moving average at around 371. So confirmation number one, losing 371, then losing 367.29. Then you got a reversal process here because the RSI is in negative divergence. The MACD is already given us a confirmation here. On the weekly chart for Microsoft, we see a reversal candle, but again, we're waiting confirmation of losing 367.29. Closing below that number will initiate more losses here in a retracement of the recent move in MSFT. Tesla, the souffle daily chart, what do we see here? We talked about we have consolidation. You break above 242, we got to trade all the way to 250 to go to the top of this channel that you see. And indeed, we got to the top, which also coincided with the top of the Bollinger Bands. Then came the Cybertrash news. We lost the 242, so we got a put trade all the way down to 230. Now we got to 230.61 almost, which also coincides with the 20 days moving average. If we lose the 20 days moving average and we lose 230.61, then we got to trade all the way down to 217, which you're probably going to buy the 220 puts and you sell the 210. Now, if we go above 242 again, then we have to trade above the 250 line. But we take it one step at a time, folks, because you look at the weekly chart. If we stop here below the 20 weeks moving average, then the pattern of lower highs and lower lows in Tesla will hold. It means that we're going to go down and form a lower low, reaching the 200 line. But once again, one step at a time. Of course, the risk for Tesla is the monthly chart, which really horrifying here. It shows you a topping head and shoulder pattern. And if we lose the range of 200, then we got a confirmation that the topping head and shoulder will play out. So the rescue should happen ASAP here for Tesla. It needs to trade above this shoulder line, above 300 ASAP. Question is, do we have any fundamentals that could push Tesla to that level? I don't see it. I see a margin problem. I see the Cybertrash as a big problem for the company because it is a disappointment. It's selling for more than what they promised. It's not going to be a big seller. It's going to cannibalize on the Model 3, which is the winner for this company. Anyhow, let's do NVIDIA. NVDA daily chart, what do we see here? We talked about the bear flag pattern throughout the week. We have support at 476. You break that, you're going to flush down. We got a flush down. We start to 464.25. Got a little bit of a rebound Friday. If we go above 467 again and we close above, you'll likely see more buying of Nvidia. Otherwise, the bearish momentum that you see in the RSI and the MACD will play out even more. If we lose 464.25, we're probably going to go down to the sloping line that you see in yellow, which will be support when it was resistance before. And Nvidia looks weaker, so understand if you look at the IWM, we just did that. IWM in the weekly chart is going above the 20 weeks moving average. The big caps, Nvidia, now breaching the 20 days moving average. So the big caps are showing some weakness here. Smaller caps beginning to show a lot of strength. And notice that in Nvidia in the past, when we lost and we closed below the 20 days moving average, we got to pull back from that point on average, of about, let's say, 9 to 10%. If it plays out the same way, can we go down in a pullback of 9 to 10%? That would probably push us all the way down to closing the gap that you see here. Is it out of the ordinary? No, it is really plausible. But once again, we'll take it one step at a time, folks. If we look at the monthly chart for Nvidia, it's the same thing with Apple. Can we see an ABC pattern or we blast higher? That is a possibility, but the closing of this month is really important. If the closing is below the closing of last month, no ABC pattern. Instead, we have a confirmation of a top and a lower high, and more losses to come for Nvidia. Closing above, then the possibility of an ABC breakout becomes more likely. BTC Bitcoin, what do we say here? We said that this chart is either going to flush down big or it's going to squeeze in a big way. For now, the squeeze scenario seems to be more plausible. Why do we say that, by the way? We have an impulsive rally, a big one, and we know that if the buyers don't show up, we're probably going to see some capitulation and we see a flush down. If we have a catalyst that prompts a flush down, we'll see a flush down. But now that we're above 38,000, flirting with 40,000, if we look at the weekly chart here, we go back to 2020 once again, similar look. We're expanding the Bollinger Bands. We need some sort of a mania. Are we in the circumstances that we could induce a mania with all of this soft landing, Goldilocks, peak rates, peak dollar talk? The answer is yes. And this is why I say that the squeeze scenario is really plausible. But do we have enough money in the retail mom and pops community, as we've seen back during the stimmies of 2020, that could produce such a pop? No, we don't. So this is the case right now. We have a case for, we have a case against. Once again, I think if we go to the 50,000 mark, we have a lot of resistance there. But if we go to the 50,000 mark, then I think after that, we get a big breakout or we make all-time highs in BTC. But once again, folks, one step at a time. Because for all you know, a negative catalyst shows up in the market and we see the sellers showing up in BTC. Here comes the flush down. So it looks promising if you're a Bitcoin bull, but you gotta have some hedging strategy if the other scenario takes place. This is how risky this chart is right now. Big move is due. Anyhow, let's move on to the conclusion of this video. What do we have on the economic calendar this week? We have plenty. We begin with Monday, December 4th. We have factory orders. December 5th, we have the services PMI, ISM services, and jobs opening. That's going to be important. Why? Leading indicator to unemployment. Wednesday, December 6th, we have the ADP report. Then we have productivity, a revision on that. Then we have the trade deficit. Thursday, December 7th, we have initial jobless claims, another important reading, wholesale inventories, and consumer credit. Friday, December 8th, the most important day for the week, we have the big kahuna, the U.S. non-farm payrolls. All eyes will be in the payrolls. What the cooks should give us is a plain vanilla reading. Big pop in jobs, big problem for the stock market because yields will spike again. Big drop in jobs. When we talk about the dual risk right now, we'll begin talking about the recession risk. And that's not going to be good. We're going to understand that rate cuts will happen for the wrong reasons. Wages, another important reading here, which will come with the non-farm payrolls. Before we say goodbye, folks, if you happen to be a member of this channel, we got 2 videos coming out for you. That's next. One is earnings reviews for the Magnificent Seven. Who is the true king of the Magnificent Seven? And no, we're not just going to do this one has a higher revenue growth, so it is the best. No, we're going to do trends going back to 2021. We're going to do valuation analysis and figure out which one is the best one, which one is the worst. Then, of course, we have my portfolio review, my last moves for the year. What I'm buying, what I'm selling, that's going to be for the members. If you're interested, join us. Got a little tag under the video says join. You can join us there. But with that, folks, this is all I got for you for now. If you enjoyed the video and found it helpful, please give us a like, subscribe, leave a nice comment, share it with your friends. You know the deal. But this is all I got for you for now. Thank you for listening. Thank you for watching. And I will talk to you again tomorrow. Good night.
Sitting there night after night pouring your eyes out over that old stock market. Think by now you'd be tired of it.
Well, it ain't easy, Ma, to change the habits of a lifetime.
Not a nonsense. All that buying and selling bulls and bears. Can't see how a body can figure it out.
Right now, it's kind of bearish, Ma. It's